If you're looking to buy Nikola Motor stock, or at least interested by the company itself, then please keep watching because we're going to look at the company's recent performance, how the market's treating it, and what are the technicals telling us. We're also going to try to come up with a decent trading approach given the current conditions. As the market remains volatile, we should always be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Nikola's stock price has been able to stay above the $1 level over the past few months, and so far there's no indication that it'll tumble back down from this very critical psychological level. The reason why it is important is because $1 is the requirement for public companies to stay trading on the Nasdaq exchange. Of course, companies may go on the pink sheet OTC market and being traded over there, but many institutional capital management companies will not venture into the pink sheet arena, thus removing a huge chunk of potential capital from the pool. From where things currently stand, there is little to no incentive for the market to dive below the $1 like it has been in the case back in May of this year, and the tendency does suggest that the market wants to take it to higher ground. With that being said, let's also take a look at the technicals. The trading volume of Nikola Motors recently reached around 37 million shares, versus the average volume of 47 million shares. Over the previous 52 weeks period, the price fluctuated between 52 cents and $3.97. The volume of shares traded tells us how many shares are being bought and sold at any given time in the market and if there is enough liquidity to support a trading strategy. If the float is thin, it would be very easy to influence the stock price, but low liquidity could mean that the demand is limited too. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is very large. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume, and if we were to see a pullback, it would be much lower than the average volume. The market cap of Nikola is currently around $780 million versus the enterprise value of a similar amount. As we compare the current price to the historical price fluctuations, the stock is currently 11% higher than the 1-month low, 30% higher than the 3-month low, and 102% higher than the 52 weeks low. On the options market, where we often see a hint about where the collective sentiment is, the implied volatility is 161% compared to the historical volatility of 126%. The put-call volume ratio is currently 57%. It is normal for many stocks to also tend to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 13,000 contracts a day versus the 30-day average of 55,000. In terms of open interest, the most recent volume of open interest is 1.6 million contracts versus the 30-day average of 2 million contracts. In terms of the shareholder structure, institutional shareholders own 21% of the outstanding shares. The biggest shareholders include BlackRock, Vanguard, and Citigroup. Typically, it's always preferable to see some institutional participation when holding a stock long-term, because it offers a layer of stability and a token of reliability in the medium to long term. It means that the market is confident that it will deliver value in the long shot, which is an important factor to consider for the investors. I personally consider the minimum threshold to be around 20 to 30% for institutional ownership, although there are many exceptions to this rule, as there will always be great companies mostly owned by retail traders. The current short interest is 21% of the total float, and 60% of the transactions are coming out from the dark pools. Typically, if the short interest is above 15% of the total volume and a significant portion of the short volume coming out from the dark pools, it may suggest that there are institutional positions taken to short the stock and that there would be potentials for a short squeeze. So, right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions instead of choosing ETFs. My recommendation for Nikola is to consider it as a short-term trading position to benefit from the volatilities when it goes into the right direction. It's probably for the best to buy its shares now, or at least some of your allocated amount now, and to aim for a short to medium term uptick, which will provide exit opportunities. I would recommend to commit between 0.5 to 1% of your portfolio in this stock.